few weeks on from the Trump presidential victory, and not surprisingly, the market is still trying to get a handle on what 2017 will look like. How will this all play out for stock markets, for inflation and interest rates, for advanced economies and emerging markets, and ultimately for global growth? It is clear that tail risks have increased. In other words, there's a greater potential for outcomes that significantly deviate from what had previously been factored into the markets, both better and worse than the pre-Trump base case. For example, the positive scenario of US growth outperforming and flowing through to the rest of the world positively has a higher probability now. But equally, the risk of trade wars and tariffs adversely impacting China and emerging markets is an increased risk, which all points to volatility remaining high across all markets and a fully hedged position being the safest. But what can we predict with a degree of confidence? Firstly, US interest rates will almost certainly rise on December the 14th and will likely rise in 2017 at a faster rate than previously forecast. This is one of the main reasons the US dollar index has just hit its highest level since 2003. Secondly, the sharp rise in the price of oil and commodity prices is a game changer, with Brent crude oil well above US $50 a barrel. So the rise in oil since the OPEC agreement this week will add to inflation forecasts, especially when combined with the Trump fiscal package in the States. Inflation may quickly move from uncomfortably low to suddenly needing to be contained on the top side, although how that flows through to regions such as the European Union is debatable, especially with the latest focus on Italian banks and their non-performing loans. Which leads to the third area that we can say with confidence about 2017. Europe's political climate will continue to challenge the EU, with this weekend's Austrian presidential election and Italian referendum a precursor to next year's elections in the Netherlands, France and Germany. Austria may well be a bellwether. If the Freedom Party's Hofer wins presidency with his right-wing anti-Euro platform, then the Brexit dominoes may keep falling. Back home, the market shrugged off the poor capital expenditure and buildings approvals numbers this week to maintain recent gains on the stock market and to continue to unwind rate cut expectations. As this chart shows, the Spring 16 cut failed to materialise, and now 2017 has a rate rise rather than a cut partially factored in, which begs the question, why aren't borrowers looking to lock in debt? The risk-reward for doing so appears to be improving based on rising swap rates and rising oil and inflation forecasts. Next week's GDP read will add further clarity. It's always a difficult call when to lock in, and sentiment can turn quickly. But the latest data from China was also promising, offsetting other offshore worries. So we'll keep a close eye on swap rates over the next few months to keep you updated. And finally, the Aussie dollar has been under pressure due to the stronger US dollar, but remains in the broader 73 to 78 cent band. It's tempting to call it lower from here, like the rest of the market, but it is worth looking at the Aussie yen cross rate, which is actually moving higher, up to almost 85 yen from below 77 only a few weeks ago. More on that, our currency forecasts, and Australia's GDP data in our next update in a fortnight, our last for 2016. See you then.